Mortgage applications are on the rise and lenders are making more credit available as the market is shifting toward purchases. But becoming a good candidate for a mortgage requires a lot of patience and a lot of planning. And here to talk about it is Francisco Reynoso, Manager of Real Estate Lending at Cal Coast Credit Union. So thanks for being with us.
Thank you, Linda. It's my pleasure to be here.
Yeah, so how do we become a good candidate for a mortgage?
Well, I think there's doing some research, some due diligence, becoming familiar with some mortgage terms. Visiting a financial advisor. One of the first terms that I suggest becoming familiar with is the debt-to-income ratio. It's quite complex, but in a nutshell, it's a comparison of your gross wages versus the liabilities that you currently have in mortgage debt or a future mortgage payment in any credit report that you have.
Okay, so how do we do better to stick to a budget? You know, we all know that we should and we need to, but how do you just get better about that?
Well, so a mortgage lender is going to tell you what you qualify for as far as a payment. But you also have to be comfortable with what payment you can afford regardless of what that lender tells you. You do have to be aware that if you're a renter and you've never owned a home before, that there's going to be additional costs that you might not have thought about. For instance, a mortgage payment includes not only the principal and interest, but you have taxes, property taxes, you have insurance. In the case where you put a low down payment, you might have mortgage insurance. With a condominium, you might have HOA fees. So knowing about all those potential costs, how much they add up to based on the property size you're looking for is important.
So what about credit history? How much does that matter?
It matters a great deal because credit history to a certain extent is going to dictate the interest rate that a mortgage lender is going to offer you. The higher the FICO score, the lower potentially the rate is going to be, also coupled with a down payment.
Okay. And what about credit inquiries? You know, people are listening, they're watching this and going, okay, well, I want to go find out what my credit score is and that kind of thing. But you really have to be careful about how many times you look into that?
Correct, and especially around the time that you're applying for a loan. Any inquiry, regardless of whether you're applying for a mortgage loan or not, has the potential to lower your FICO score. So you want to refrain or limit the number of inquiries that you are pulling at the time that you're going to get a loan, because then you are going to potentially reduce that FICO score, and that FICO score is, again, going to dictate your interest rate.
Where does it need to be, roughly, in order to get something decent?
So the best FICO score typically FICO score can range all the way to 840 or thereabouts. Mortgage lenders are going to be looking at a 740 FICO as typically the highest tier best rate, and then they go in 20-point increments below that will yield different rates.
Okay, and saving, how important, and you know, for people who are saving up for a down payment or for closing costs or both, what do they need to know?
So the good news is that there are a lot of low down payment programs out there. There are programs that might offer 100% financing. More prevalent, you have 3 to 5% down payments. But the more you're able to save, again, the lower potentially your payment is going to be, the lower the interest rate, or both.
Okay, and then where could we get some more information and tools? You know, it's hard for people to take all these notes during these segments, but they want to know more details.
So you can go to our website, you can go to calcocu.org, and you can go to our links for Know and Plan, and that will give you some good starting points. But again, calling our financial advisors is a good idea as well. And doing some additional due diligence, looking through the internet, pulling a credit report. The credit bureaus do allow you to pull a credit report once a year, and that'll help you determine where you stand.
But really, we don't want people to be discouraged too, so they can at least go and inquire and find out where they stand, even if they think maybe it's
a little bit like the doctor's visit, right? You know, sometimes you're going to hear things you don't want to hear, but finding out where you stand is very important. So sitting down with a financial advisor, a financial planner, a loan specialist that will be able to run the numbers for you, help you calculate those debt-to-income ratios, tell you based on the assets that you have what that's going to translate into a down payment, a sales price, a loan amount, and so on and so forth.
All right, Francisco Reynoso from Cal Coast Credit Union, thank you so much for being with us.
Thank you so much, Linda.
All right.